Good morning, traders. Welcome to the Flow Show. Here we are, the day after the night before, and what fun and games I had yesterday. Probably one of the most exciting Fed meetings, at least this year, but in a long time. And that's what we live for, a bit of volatility. Obviously, we'll go over all the details and what happened, just to get you up to speed and looking at what's coming ahead and where we go from here. Morning, Kay. Got the old coffee on the go, keeping awake.
Yeah. Oh, yeah. No need for matches in the eyes now between the eyelids. We are awake and well, mate. Yeah, everything's on the move. Sorry. And just to start the show, nice trading on the dollar yen, mate, yesterday.
Oh, thank you very much, mate. Thank you very much. Good effort by lots of people in our chat room yesterday. It's always a pleasure to watch people making money, whether I'm making money or not. Always like to see that. And some good sniping by you as well, mate. In and around, lots of stuff to jump into. But it's as we said, we were pretty relaxed going into it. Not really looking at anything in particular, and it just ends up that you just react to what's put in front of you, really.
Yeah, absolutely. I must say, I needed a good few a good few minutes actually to digest the extra bits after the first addition of another cut, perhaps this year where the dollar got smacked. Luckily, yeah, I covered most of my dollar shorts there, but I needed a bit more time than you needed to realize it wasn't that dovish a meeting at all.
Yeah, we've all been there. So, sometimes something looks too good to be true.
Yeah, I mean,
But that's
it
the way it
was
goes.
it was funny. Yeah, but well, we will go over it. I'll
Yeah,
let you
we'll go for
I'll
it.
let you talk.
No worries, no worries. Right, let's start with a bit of data out of Japan. We had some core machine tool orders, which not looking overly good. A bit of swingy aroundy. Core machinery orders down 4.6% on the month versus a prior 3% gain. Far worse than expected. Year-on-year numbers also coming down less than or more than expected to 4.9 from 5.4 expected, 7.6 prior. So a little bit of a wobble there. These are July numbers though. So again, right in the middle of all that trade stuff and everything going on. So pinch of salt with that. Both me and Kay thought this was already a done deal, but it's more of a done deal. Takaichi is apparently officially now in the LDP leadership race. She's already leading the polls, so she better be in the race because they're polling about her at the moment. Anyway, she's going to hold a press conference on her policies on Friday. And yet again, we saw a little uptick, a little sell-off in the yen, uptick in yen pairs when that news was dropped. So it just gives you an idea. She's the most bearish for the yen according to the market. The other candidate, Hayashi, he's unveiled more of his policy plans. He's been a big proponent on getting wages up. He also says he will set up universal credit and support low-income groups and is aiming for a sustained 1% gain in real wages. All these runners and riders are going to be dropping what they're going to be doing or hoping to do if they get in the running. And focus is going to ramp up on that sort of thing once we get past the Bank of Japan on Friday. Bit of a disaster in New Zealand. A bit of a disaster for my Aussie Kiwi shorts as well. GDP for Q2 coming in at minus 0.9%, far worse than the minus 0.3 expected. Year-on-year number also coming in negative 0.6 versus a flat number expected. Not good news there. Although, to be fair, the RBNZ has been saying that they're not expecting Q2 to be particularly good. I don't think they thought it was going to be as bad as that, though. So the market now getting back on when are the RBNZ next going to cut. On the other side, we had Aussie jobs as well. Employment coming in, missing expectations. Was expected to post a 21k gain. Instead, it fell 5.4 thousand. Full-time employment doing most of the damage there, down nearly 41,000, while part-time, I think it was up 35.5. Yeah, 35.5. So a bit of revolving door there. The unemployment rate stayed unchanged, though, at 4.2%, likely because of the fact that the participation rate dipped back. So that was a case of the data could have been a bit worse if that participation rate had stayed where it was. Probably would have seen the unemployment rate rising. But overall, yeah, a little bit of a swing around in Aussie jobs. Don't think it does much for the RBA unless we see a weakening trend developing in that jobs market, or stronger developing trend over there. Kay, first off, before we move on to other things, just the Kiwi and Aussie data. Are we getting a bit more divergence now?
Yeah, bad news for Oceania overnight, we can say, right? Yeah, that Kiwi, even if it's back looking, we're already nearly at the end of Q3, but even if it's bad looking, that was not expected at all. So that, yeah, really double whammy for the Kiwi overnight. Already having rejected the 60 level over the FOMC, and then when that GDP came out, it dropped under 59 cents. It's okay. We've seen big moves, but it's rare to see a more than a big figure move in the Kiwi over 12 hours. Also, probably due to the size of the market being smaller than most of the developed markets as well. But yeah, that's not good news. That is, yeah, and knowing the RBNs, they are more easily, I would say, tempted to go into the defensive, and I guess the hike in pricing expectations for the next cut is pretty much justified on the back of those numbers. They also have less than Australia in digging exports, etc. Even though they export a lot, but to rely on, perhaps to recover from all of that. So yeah, I think got to be a bit careful with the Kiwi. Compared to peers, it may stay a bit more offered. The Aussie there, in turn, that was interesting because even if we had the rejection as well, I had a bit of a trend line there, and we actually just tapped it just above 67. We did also reject, but then 66.20 is a bit of a support of my charts, and we kind of held that. So that still gives you, as you were showing before, this divergence in Aussie Kiwi. Aussie is still holding a bit better, right?
Yeah, it's still the darling out of those two. And for this one, I don't know where it's going to turn around, but I'll talk about more of what I'm going to do with that position in a little bit.
I actually don't know what's going.
Yeah.
I actually don't know what's going to turn it around straight away.
No, me neither.
Yeah.
This could be on for a proper rocket. We could be, but ranges are there to be broken. Just because this range has been in play for 11 years doesn't mean ranges are going to break. This could be the time it does. We shall see.
Yeah.
Who knows? Right, moving on to one other bank who perhaps might have been a bit more uncertain over the outcome was Norges, where they ended up cutting by 25 pips. They also noted that if the economy evolves broadly as currently projected, the policy rate will be reduced further in the course of the coming year. I assume they mean next year on that one. They also said a higher rate is likely needed versus their June outlook, and that restrictive policy is still needed. The governor saying that the timing of the next rate hike isn't certain. So this one, and I used monitoring. This one sounded a far less dovish cut than the numbers suggest.
Yeah. They changed their stuff, because they were kind of hinting at this cut to come in the last quarter of the year, which they did, but now they're pushing back, and as we've seen in the statement, they're expecting to go to 3% or just over 3% by 2028. So that means that their projection, if we can call it projections, are now for one cut. Or, I mean, in simply put, one cut a year, into 2028, which is, in my opinion, a quite hawkish quite hawkish cut. They also said that their economy was doing slightly better than expected. We also can't forget that Norway is going to be the beneficiary if Europe continues to cut the energy imports from Russia, which are in the plans. So I'd say it's pretty positive for Norwegian kroner. We haven't really, we had this pretty quick blip after the announcement. No, Norwegian kroner strengthened for, what is it, a good 0.5% or so, but we are sort of back somewhere in the middle, where we were trading right now. But I do think, though, that overall the Norwegian kroner should remain one of the currencies that is performing pretty well.
Yeah, and that should continue. I mean, it wasn't a shock that they did cut in the end. There could have been a case why they didn't, and yeah, not overly huge reaction in that. Knock after all that. Right, let's move on to the ECB clowns. Nagel says we're well advised to, the ECB is well advised to remain cautious given the current uncertainties, and we're well positioned to respond to unexpected changes. ECB's De Guindos says present policy stance is appropriate and that risks from fiscal policy are becoming more tangible. His sphincter would have been flapping a bit last night watching the euro, but he says there's no targets for the euro FX rate. We look more at the exchange rate evolution. He was one of the first to start putting 120 into language. So he was keeping a close eye on what went on in that yesterday, but otherwise not that fussed. Bit of data out of the US yesterday, not an awful lot. Ahead of the Fed, we got housing starts and permits, which came out a little bit on the weaker side. 1.312 for building permits, a miss of expectations and prior, and the same for housing starts. Again, no big yellow flags being waved here. We're still working around half decent numbers. We've seen some ups and downs, but nothing that's showing a trend one way or another. Bank of Canada, they cut their rate by 25 pips as expected. Statement saying there was a clear consensus on the governing council to lower rates, and that the cut was appropriate given the weaker economy and less inflation risk. They're now proceeding carefully with their focus on risks and uncertainties. They also say that the near-term risks were lowered, but risks now shift to the US MCA renegotiations. Macklem said that they considered holding the rate overnight steady, overnight rate steady. Says the inflation picture hasn't changed much since January, though we're not being as forward-looking as normal. Said they have more comfort while looking at upward pressure on CPI, and they're prepared to take more action if risks tilt further, and we'll take it one meeting at a time. They seem in neutral at the moment. Well, again, they seem to have done one cut, and now they're back in wait and see mode. Okay, are they done, or are they going to keep half an eye on what the Fed does as well?
Yeah. An interesting little comment that may have gone lost during the press conference was that actually the discussion was between a 25 BP cut and a hold, not a bigger cut. So McClem was hinting that they may be done and now waiting for what's going to hit them next, whether it's tariffs or whether it's whether it's tariffs or whether it is anything else. But yeah, they may. If you look at where they are now and where inflation is, they're probably somewhere where they want to be and can sit and wait for a bit.
Yeah, exactly. Right. On
Brian, I'm
to,
sorry, I need to take a call quickly.
yeah, go ahead, mate. Go ahead.
Yes, I'll let you know
Right.
when I'm back.
Yeah. Right. We're on to obviously the big event, the FOMC. They cut rates by 25 pips as expected. That was pretty much along the lines of most people, though there was some small pricing for a 50. Now, what was dovish and what was not overall? Just in my opinion, none of it was dovish. None of it was as dovish as the market was expected. So they confirmed. Oh, let me get this sheet up so you can see everything. So they confirmed that there would be a total of 3 cuts, or the median expectation is for a total of 3 cuts coming for the rest of the year. So that's including this one. So 2 more cuts to come. So they took their June projection down to 3.6% from 3.9%. That's what I was expecting them to do. There wouldn't have been that much difference if they'd only signalled 2 cuts, but they've signalled a total of 3 cuts, including yesterday's. For that was what the market saw as more dovish and why we got the dollar sell-off. But that was what first got my antenna poking up that the market may have been reading this a bit wrong. They cut their 2026 projection by 1 cut in terms of the percentage move from 3.6, and these are midpoint numbers, by the way, 3.6 to 3.4. So they only see 1 cut in 2026. As we've been pointing out, a lot of the market had been looking for 2 cuts. If they cut 3 times this year, they would look for a further 2 cuts next year. So they were only looking at 1 cut in the prior dots. They're still only looking at 1 cut in this one. So that rate was a little bit disappointing for the market. Nothing changed for 2027 either. They still see 1 cut as well. They took the rate, the midpoint or the median, down to 3.1 from 3.4. So those dots were not as full as dovish as the market expected. So now we've only had 1 real dovish thing, and that's the 3 cuts this year. So not as many cuts for next year. Then we had the votes. The only dissenter for a 50 was Miran. No Waller, big mouth Waller, trying to talk his way into the Fed chair. No Bowman, just Miran. So that was an undovish move as well, because you would have thought that, at least Waller would have piped up for a 50. But no, he stuck with a 25. So Miran was out on his own. Then they raised GDP forecasts. Okay, so they see, forget really 2025 because we're in Q3 now. But anyway, they raised it to 1.6, 2 pips. They raised 2026 up 2 pips. They raised 2027 up a pip. Okay, so they've raised up their forecasts for GDP, undovish. Inflation, unchanged this year. They ramped it up 2 pips for 2026, kept it unchanged for 2027. So they do not expect inflation to hit target until 2028. Okay, 2028, undovish. But the real shocker, in my opinion, was the unemployment. They cut because they're worried about the jobs market. Okay, they kept the unemployment rate unchanged for this year. They lowered it for next year. They lowered it for 2027. And even the longer run is coming in lower than that. Okay, case back. So again, you're worried about the jobs market, but not worried enough to see a higher unemployment rate over the future, over the next few months and next year. Undovish. So all these things are coming out, and I'm sitting there seeing the market sell dollars hand over fist. It just didn't compute, in my opinion. Then we get to Fed chair. He said inflation has risen recently and remains somewhat elevated, and dovish. The moderation in GDP growth largely reflects a consumer spending slowdown, a bit dovish. Activity in the housing sector remains weak, a bit dovish. says payroll jobs gains have slowed significantly, reflecting lower immigration and lower participation. Demand has softened. A bit dovish. He says PCE prices likely rose 2.7% in August, and the core rose 2.9%. Undovish. He says beyond next year, most inflation expectation measures are consistent with the 2% goal beyond next year. And dovish. He says the balance of risks has shifted to the downside to jobs. Dovish. No widespread support for 50 basis point cut today. Undovish. Doesn't feel the need to move quickly on rates. Undovish. Could think of today's cut as a risk management cut, i.e., we're doing a just in case cut. Undovish. Says our job is to make sure it is a one-time rise in inflation, and we will do that job. Says don't think we'll get to a place where the Fed is making decisions based on political considerations. Don't know that a quarter point cut will make a huge difference. Now, a lot of people picked up on this. Powell is usually, or has been, since the old transitory arse kicking, he's been very, very solid. But this presser, he was all over the place. What do you make of that, Kay? I wouldn't say he was flustered, but he just his lines and his answers were just a bit pillar to post.
Yeah. First of all, you're completely right in summing up the mostly undovish thing. That the unemployment rate adjustment though is a rounding thing because they actually tightened the range that they expect for 2026, and then the median, this 4.4 is probably 4.44, where the other one was 4.46, and ending up in a 4.5. But yeah, for the rest, apart from that, adding a rate cut in 2025, so that is front loading the cuts, which was the first reaction of the market. Mine in a way too, but then I quickly reacted to it. But I found the press conference really nearly a fight against Trump also, or Miran, depending how you want to pronounce it. That was what it was more sounding like, because he really dismissed at a certain time. He dismissed the importance of the dot plots. He says like, yeah, but look, there's enough people not voting for too many cuts, and I suspect that he's one of those dots that remains higher than the rest.
Yeah.
And he spent most of the meeting trying to fight against whatever too dovish he may have to say. So it ended up being a pretty hawkish meeting, actually. Cut, yes, but in fact, those it's a risk management cut is actually 3 words that summed most of it up in his view, and I guess the market got a bit carried away on that initial third cut for this year, but even him during the press conference didn't seem to overly support that view, right? So really, the more this presser went on, the more it sounded as if yeah, well, we'll cut if I really need to, and if the job market forces me to do so, but I'm not really in the same boat, and that I think surprised the market quite a bit, and that is what the reaction that we had then afterwards, and especially as well that the short-term reaction, people are piling into those dollar shorts, then all of a sudden you go like, oh, it's not holding, so I got to cover them. Then it goes more, then it goes even lower, and then you sell even more, and I guess now this must have been some people selling below 118 who are regretting it as well, because we're back in the middle of the range. Which, by the way, and I just want to say this once more, which, by the way, if you look at the amplitude of the move that we had in the euro dollar, and you look at the overnight straddle, and you take the extremes in the FX option market, and that is exactly to a couple of pips close. It's exactly the expected range of the option market once more. And I've been repeating that a couple of times already. Don't dismiss those things, because they do have an importance in what is happening after an event, because they will have their interests parked on either side of that ridge.
Yeah, absolutely. And yeah, I've got to say, you have to. We always say you got to watch the market and see what the market's doing. I think the big sell off in the dollar that we got Tuesday, as I mentioned, or Monday, Tuesday, I think that was partially behind why we saw a big reversal reaction yesterday, because the market didn't get what it wanted, and that last bout of dollar selling just got more and more shorts in that they had to then, when they were proved wrong, had to get out. So that reaction was not a surprise. It was more surprise that we sold off in the first place, but that's neither here nor there last night. But the reaction, we were expecting it. Blake was expecting it. I was expecting it. Or the risk that we had a big reversal in the dollar once we knew what was coming. But the longer that, and I'm not talking about trading, my trade, or anything like that. We've had the last 2 weeks here, me, Kay, everyone else for its analytics. We've had these last 2 weeks nailed every move, even when things were a bit surprising, like the reaction after the PPI and CPI data. We saw how the market reacted to each of these things, how it built up expectations. And as I say, it's probably been the most clear meeting for seeing how the market has performed throughout this to get to the point we're at now. Okay. So I hope what we've been trying to show you over the last 2 weeks has sunk in. I hope you can take that and use it the next time we have a Fed meeting, the next time we have an important Fed meeting. Trading aside, just understanding how markets work, how they function around these things. What you've gone through the last 2 weeks is your experience for the future. Okay. The only thing that me and Kay have is more than some of you guys is longer experience of watching this stuff. And now this is what you should be learning. So you need to take everything you've seen over the last 2 weeks, whether you traded it or not, whether you made money or lost money, it's not important. Take that experience, because when we get to the next big Fed meeting, I don't want to hear you asking us the same questions that you asked before this one. I want you telling us what's going to happen, because that's what you needed to learn from all this. It's not about me and Kay saying, yeah, we were right, we want a pat on the back. It's about us saying, learn this shit, because this is what you need to do and what you need to learn moving forward. Right, anyway, so where do we go from here? Well, Nomura, after being told by the Fed in their forecasts that they are likely to cut twice more this year, they now expect them to cut twice more this year after only expecting them to cut once more this year. Fucking hell, I don't know how they get away with this shit, I tell you. They also expect 3 cuts in 2026, so that's slightly more dovish than anyone else. They see 25 pip cuts next year in March, June, and September. Right, so what do we do now? We've had the Fed, we know what they're doing. Where do prices go from here? Now, as I said in the room yesterday, there's 3 reaction functions. The initial reaction yesterday, the spikes, the reversals, all that sort of stuff, the market reacting to the news, what Powell says, the forecast, whatever. Today is a reflection day. Okay, in the cold light of day, the market gets to assess it, really look into it. What does it all mean for the future? What does it need to do? Is it overpriced, underpriced for whatever the news we've got? Today is a reflection day. Tomorrow, probably from next week, is a what next day. How does the data evolve from here? How will that data affect what we think the Fed are going to do with rates? We're now back in that situation from a couple of months ago or before the summer where, a data point that was amiss was a sort of 10, 20 pip move and rate expectations changing by a few pips. September coming in, the last 2 weeks has been about what the Fed does for the next 6, 12 months. From now on, we go back to trading the minutiae of it all, the little swings, the little changes. For certain pairs, like dollar yen, we're going to see a shift now to what's happening in the election. We've got the Bank of Japan on Friday, not expected to do anything. Doesn't matter. It's still a risk point for the market. So the market's probably not going to push things too far in the yen ahead of that. But once it gets confirmation of what the Bank of Japan has done, unchanged, whatever it may have signaled for the future, then it's going to react. Then we're going to move on to what's going on in the yen and the run up to this election stuff. So no, the last 2 weeks has been about the dollar, not about the yen. After Friday, next week, it's probably going to be more balanced or tilting towards what's happening in the yen. So if you're trading dollar yen, know that where the moves are likely to come from that. The big move for me, or not the big move, but the big signal for me through all of that yesterday was this 10-year yields. And I said this was the most important chart you needed to watch yesterday. And it took a while, but we did get a poke through the 4% mark. It didn't happen straight away over the Fed. It took a bit of a while, but it ran through briefly and then bounced again. Okay, so that was your signal about what the dollar was going to do. And the dollar moved a lot, even though this hadn't moved initially. Let me see if I can show it a bit closer. So right in there, we were down here a bit and it had a little poke and then it floundered around a bit and then it was soon quickly back up. And the dollar went quite some way, even though that was sort of a, 4 or 5 basis point move, not a huge move. But coming back above that 4% was the kicker while I was sitting in a position. And that was what I was keeping my eyes on. Where are we now? We're sitting in the middle. Okay, this 408, 409, we're sitting at 404.5, bang in the middle. It's, as I say, this is a reflection day. So what this does now is going to potentially determine what the dollar is going to do. If we come down to 4% and hold it, fine. We'll see a little bit of softness in the dollar, maybe not too much. Now we're going to get back into ranging and the market isn't going to go too far. For something like dollar yen, we had this breakout. We knew this was support down here. It's not going to do anything 10 minutes before an FOMC. Hence, we got a big reaction. The fact that it stopped at a level higher than my chart is neither here nor there. Sorry, let me go in a little bit, that one. So I did have a level down here. We had this fib, the 61.8 here, broke that, broke another level. It's decided to stop at this level. Fine, that's the stretch point. Okay, but it got back quickly into the range. So we're back above this 146, 20s, 30s. We're back above 50s. We're back above the 80s, which has been sort of the more walked range. We're back into 147 and we're back into 147 and holding that move into 147. We're holding the move back above 80s. So again, these levels don't count for shit 10 minutes before, 10 minutes over the FOMC. A day later, now we see, are these levels valid again? And by and large, they are. So I wouldn't be surprised if this maybe creeps up to 148, but this one is not for breaking at the moment. And you can look at a few other pairs. Cable, forget the spike, noise. This was my key level, 136.70. We held it before. We held it just before. We broke it. We're back below it. Is this level going to be key again? If we hit this level again today and it holds, then I reckon we're going into maybe another range. We've already had the dip and it held where it needed to hold. This break point, 135.90s. We had a little poke through on Monday, just there after the first 136 break. That's where we held in this move. So you know your range, 135.80, 136. If this is going to collapse all the way down, it's got to get through there. It hasn't. It's holding it. So it keeps the top side in play. Have we moved up? What we might get is a little bit of a, if I can get my little scribbler, where is it? Lost it. Oh, there it is. What we might get is maybe a bit of that going on now. But if we're moving below this level again, we're going back into this box here, back into all this noise, and we've got to do all the hard work again. Kay, what's your overall thoughts of things and where we go from here.
Hello. Yeah. Sorry,
Yeah,
mate.
that's all right, mate.
My thoughts on. Sorry, mate. I was again on the phone. My brother is calling me all the time.
No, it's just your general thoughts about what we do from this point.
Yeah, I heard
Direction.
you say about ranges, etc., and I think we still have to reckon with it. Um, I was just saying in the room as well a bit earlier that euro, and we were saying that yesterday as well. Euro still looks like one of the currencies, despite being only at 2% if you look at the interest rate differentials. But euro is still one of those currencies that seemingly is holding pretty well. So I would say that if there is range developing still going on, or maybe a little bit of a fresh range, above 117 and a half and then 119, 119.15 or so, I think it's perhaps the possibility that euro holds a little bit better if we see more dollar buying. We will see how the US session this afternoon will develop because we have a little bit of data, but especially what they think about their own currency, of course, when they come in. But it does seem to me that euro may be one of those that holds maybe the better. Yen definitely is on the defensive, so I think dollar yen is going to find bits on dips. Um, and then Aussie and Kiwi, again, I mean, we've been talking about both of them. Aussie is already coming back to the middle of the range as well. And so I still think that Aussie is also among those who could respect the ranges better in case we see more dollar buying than perhaps some other currencies. And in general, yes, we still, if the meeting was completely undovish, even on the hawkish side, we still can't fully dismiss the fact that they brought forward another rate cut. So that I think is likely going to keep the overall dollar picture a bit more in a range right now. And yes, you're right about the reaction on the first day, then reflection, and then we will see what happens. I know I'm very early, but when I look at equity markets, how well they take this whole thing, um, I would expect risk to actually continue to trade a little bit on the better side, just because they indicated that extra cut this year. So that's kind of how I look at it. We can look in details and what it means for different currency pairs. But I'm
Yeah,
looking
I'll
at
pass it over to you while
I,
you.
I'm looking at when I think about yen crosses, for instance, and I know I'm coming back on those because they are important, and that's where I'm going to reply to what our friend Michael is asking. Um, the reason why I think risk is going to continue to do better is those equity markets, the fact that we are running into the LDP. I think we can all agree that Bank of Japan will be on hold. It will be a gigantic surprise if they move overnight, the coming overnight. I think they're a little bit stuck with those LDP elections. So all in all, I think the yen is still on the defensive. It is also, we can't forget, still somewhere. Um, Positive risk is a bit weighing on the yen, can help right now as well. As Ryan already mentioned as well, we had this dip in the yields. But if you look at the 10-year, Ryan has covered. But if you look at the 2 years, we are like a BP away, or 1.5 BPs away from where we were going into the meeting. So there's not a lot to take away from that. But we are seeing those yen crosses, and I was looking at a very long term. This is, as you can see, the very, very, very long term. This thing is rapidly approaching long-term levels. And if you look at it, even going back to 1992, we are in an attempt to break those levels again in euro yen. So take any yen pair as well, but especially I would say the euro yen, it is still looking very big. We are now breaking above the prior high here that we had in July. And we are on our way to this high that we had in July 2024. And if you look at the lower, higher lows, higher lows, higher lows, higher lows, continuously higher lows, these things are still bid. So that's about the euro yen that I saw, Michael, yesterday. But you can translate it to a lot of yen pairs. Look at what sterling yen is doing. By the way, um, we can have one word about the Bank of England. I think it's one of those. Uh, they won't
Do we have
change.
to?
Just put a wet finger up in the air what they may say, right? Or what they may say about QT, what we will have as a vote. But in the meantime, sterling yen is also okay on that attempt to break the prior wage. And you see it on so many of those yen pairs. They are just remaining very, very big. And that's what I've been saying quite for a while now, Michael. Perhaps we will have like reactions to the other side when we have like, I don't know, Koizumi leading Takahashi in the polls. But then even with Koizumi, to me, people say like, okay, if it's Koizumi, you buy yen. If it's Takahashi, you sell yen. For me, Koizumi is still a negotiator. So I'm not sure that after an initial reaction that we may see, just taking this pair as an example, that we may see on the yen going lower, they're really going to be extremely sustainable either. I think really the 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 next leg higher in yen will come from either two factors. Is like once the LDP elections are done, a much more hawkish Bank of Japan, or a big accident in the risk market, and then we can see a bigger rejection in yen pairs. But if I look purely at the candidates, unless we get the Motegis or Hayashis all of a sudden surprisingly surpassing Koizumi, for instance, then we could have a positive reaction as well in the yen. But this is not bearish at all in those yen pairs. That's what I just wanted to say. Um, did you look at the cable already, Ryan? Oh,
Yes.
you did. Okay.
Yeah.
So can I ask you what is it? What is going to be the mess on the Bank of England in your opinion?
Well, the expectations are split. I think Reuters is looking for an 8-1 vote. Bloomberg is looking for a 7-2 vote.
Yeah.
The difference between them, I don't think, matters a lot. In
Mm.
theory, it should be more a 7-2 than an 8-1 because we know Ding was likely to vote for a cut.
Yeah.
And the fact that Taylor voted for a 50 or tried voting for a 50 last time and only got a 25, you'd reason that he'd want another 25 this time around.
Absolutely.
But as I've mentioned to someone else today, reason and the BOE don't coexist in the best of times.
No,
So yeah,
and we had the example yesterday with Waller and Bowman not voting for
yeah,
50s. Mm.
exactly.
Um,
I think it's there's not much change between the last meeting and this one economically in terms of jobs, inflation, and whatnot. A little bit soft on inflation, jobs, yeah, a bit more like this week. It's really going to be the QT stuff that's
yeah.
going to do something, I think. But I've not even been digging in depth into that because it's all going to be a whole load of waffle.
But I mean, I doubt that it has the potential this QT stuff to completely to I don't know if we
Unless
just
it's more than
rally a
expected.
lot higher on the gilts. I
Yeah,
don't I don't know. Maybe the odd 10, 15 PPs more, but well, which would already be a move. But I'm not sure we can really we can really hold all of that. Yeah, I don't, looking at the fiscal situation. Maybe you know what? I'm really thinking that these, unless they start to go all strange about those QT things, could be a Bank of England meeting that is quickly forgotten.
yeah, probably. I've already
Mm.
forgotten about it, and it hasn't even happened yet.
Yeah. Did you look at the Aussie? I'm sorry.
Only just briefly, just to.
Okay, Aussie, to me, there's this trend line, and we banged our head against it yesterday, right on the FOMC. I was extremely lucky to let the rest of my Aussie dollar go there, and it was actually more because of the trend line than my initial analysis, I must say, of the FOMC, which was a bit slow to come yesterday. But the funny thing is that after that rejection here, then the dollar bit, and then we had the additional whack down on that employment report. We held this one here, and this is also one of the reasons why I think, okay, we don't know what's going to happen, but Aussie is trading at 66.55 again. It's not trading 66.15.20. Okay, a bit in line with what's happening in the euro. So I still think that Aussie and the euro, they could actually, and we will see with the cable or the sterling after the Bank of England. But they are the ones that are, how should I call it, the stabilizers, or the stabilized, or the better looking currencies, if anything positive or negative for the dollar would happen, those will still have the best elasticity to move higher. So I would not dismiss this 66.15.25 because it is around the prior high. It's around where we stopped before we also pushed through. So keep a close eye on what's happening at 66.15. 15.25 if we get back down there. I don't know who was asking for the Aussie dollar, but I think this is what I'm looking at. It's Aussie is not the one, is, let's put it that way. Aussie is not my preferred short versus a dollar if I would be short a currency versus the dollar. What's happened on the S&P? Somebody is asking. Well, it's whoops, why is this? It's bit like hell. It is bit like hell, and we couldn't correct much lower. If you look at this, for instance, um, if you look at, no, this is not.
I was going to short it here at 66666666.
Yeah, I know, but well, I mean, you can still
No
give it a
reason
go.
really, but
You can still give it a go, but I would be worried if that thing. I had, maybe it's maybe I had a wrong line put in there. Oh yes, I think I forgot one. This one here. This comes in at around at 6,700. But the thing is as well, and I agree with what Michael Brown actually said in the thing. They have front run, or they are front running an extra cut. They are the results that we have seen, quarterly results, are not doing too badly either. We have seen tries to break through levels, and just note that those lows are increasingly higher as well. So there's still nothing really bearish to me about what's going on in the S&P. Only below 6,500, I will start to change my opinion now. But what's going to stop it? I mean, the real question is, what is going to stop it? Bad numbers are really, we need bad data in the US. It's as simple as that. If you get an extra, but we have to wait 2 weeks for that. If you get another very weak employment report, then yes, okay, then yes. But what's weak these days? If we know that the break-even rate is somewhere 50K, some people even think that's below. Like what's his name, Musalem. Um, so I mean, it's already going to have to be a very weak report to stop this. It's just too much money chasing all of this still. I've been saying for a very long time, the times that we had, when you look back at historical moves, the times that we had, for instance, in even the global financial crisis. I should have gone on to a different one. But if you look at what's happening, and also already from after the pandemic, in general, there is a lot more money, multiples of money in the market that's been injected since the global financial crisis, and then another huge leg, which is not completely out of the markets yet. And in the meantime, people have made money, created money out of those moves as well. So there's still a huge amount of money doing the rounds in the markets, and a very simple thought or a very simple reflection on that is money has to be put to work. People will always put their money to work. Okay, so for me, I mean, yeah, there will be a top one day. There will be a top, and there will be, whether it's an intermediate top or not, because we know that historically, in the very, very, very long run, this thing is only going up anyway. But there will be setbacks, but we need a very strong catalyst, in my opinion, for equity markets to drop. Another one that may happen is that a blow up between US and China. Okay, that could be a catalyst, for instance, but will we have it? And I think, Ryan, I've showed enough today. Just wanted to show the last one is the Kiwi, because it's still looking worse, far worse than the Aussie, right? So we had this little blip up above 60, just above that 61.8 here of this move. Was looking very positive. Rejection. Then we had the FOMC, the press conference, and then we had that awful GDP revision for the Q2. It is not looking, to me, this is not particularly looking good. We're going to need to see a very offered dollar to take this back up. And I would say on the day, look at this level here, 59.20, 59.30. On the back of what's happening, on the back of where you look, where Aussie Kiwi is trading, etc., etc., this looks a lot weaker than the Aussie is looking, for instance. So I wouldn't be surprised that any attempt to get back into this zone will be met with sellers today. And I would be very careful if this thing starts to break below 58.75 again in the Kiwi. So that is one of the currencies, contrary to the euro and the Aussie, where if I want to be long dollars, this is to me a candidate on a blip higher. And with that, Ryan, back over to you, mate.
Thank you very much, mate. Ali, I'm not sure what you want me to say. If I read you right, you had a position, you moved your stop up, so you only lost half as much as what you originally set out to do. I don't know what you're asking. You've risk managed. You've reduced your risk. You've ended up losing. That's trading, but you've only lost half as much as you set out to do. Yeah, you've done well. I don't know what you want me to say about that one. Anyway,
maybe review the risk management webinar that we had a while ago.
Yeah, that'd be a good start. Yeah, but you've done the right thing. You've got your risk down when you could, and that's all you can do. That's what you have to work towards. Right, thank you everybody for coming to the Flow Show as always. We'll see what happens today, and then we'll update you all on Friday, the end of the week, tomorrow. Can't wait. Have a good one, everybody.